Good morning, and thank you for joining us for what is somewhat of a special presentation. I am David Waddell, CEO and Chief Investment Strategist of Waddell and Associates, and I really appreciate you all clicking in. For those of you who may have seen our presentation, our 2021 Outlook, the spoils of war, you may recall that we spent a lot of time trying to frame the post-COVID environment using what we learned from the post-World War II environment. And I talked at length about the benefits of the government stimulus, and I talked at length about the benefits of, kind of a wartime economy where there's a lot of innovation, a lot of experimentation. Obviously, what's happening with vaccines right now is super fantastic. We've never seen anything in terms of speed or scale like that in the past. We have stay at home. We have a whole lot of digital innovations that are happening in the economy. All of that is positive. So there are a lot of positives to what's going on in the economy right now. What I didn't share at length in that presentation was the cost and what occurs on the negative side of the ledger from a post-war economy. Today, we're going to talk a little bit about that. So I'm going to give you two slides because I can't do anything without slides. And then I'm going to hand the microphone to my own personal financial advisor, Perry Green, to talk about some tax strategies, talk about the environment for taxation. I think it's as big a game changer as what we saw in 1986. And it's incumbent upon us as your wealth strategist, not only to be well prepared, but to be active on your behalf. Because as I said before, if we make you an extra 10% in the investment portfolio, that's great. If we can save you an extra 10% on taxes, it's the same thing. We're in the net worth business. And so this may be an opportunity as we go through massive tax reform for us to add a whole lot to your balance sheet by eliminating maybe some of your tax exposures. So to frame this, bear with me. You'll recall this slide. We've gone through a massive amount of government expansion to deal with the COVID crisis. And this chart chronicles total federal spending as a percentage of GDP, and you can see the spikes. World War I, we saw a big spike. World War II, we saw a big spike. COVID-19, we saw a big spike, and we're not done yet. This does not include the 1.9 trillion that was passed into law, I guess, 10 days ago. And it also doesn't include, Biden's going to talk this evening about the infrastructure plan, which by some estimates is $1.6 trillion, and by others it's $3 trillion. But the Biden plan to save America with the Democratic Congress has a whole lot more spending in there. In fact, all of it added up could be 45% of GDP. So make no mistake, what the government has dealt with COVID has been warlike, okay? So this is what wartime spending looks like. Well, here's what I didn't tell you at the 2021 Outlook. They also, if you look at history, have massive taxation regimes that follow. So if you look at this chart, you can go back and see that during World War I, and this is actually a chart that's averaged across the 20 developed nations, but the point is the same here domestically in the United States. We saw a massive increase in tax in response to the World War I spending efforts. We saw a massive increase in tax due to the World War II spending efforts. We haven't really been in a global sort of catastrophe like a World War II until COVID has come along. In that interim period, we've seen taxes on the top 1% or so, and this is the highest bracket and the highest inheritance tax, fall, over that time period during a basically peaceful period. But now COVID has happened. The government spending has exploded. What is that going to do to the tax regime? Well, if history is a guide, we're getting ready to get an avalanche of higher tax rates, which freaks me out in the middle of the night. And so when I freak out about taxes, I call upon the best person I know to answer and alleviate some of my concerns. And that's Perry Green, who is our lead wealth strategist here at Waddell and Associates. And if you don't know Perry, the reason that Perry has a job here at Waddell and Associates is when we decided that it was mission critical that we put together as robust a financial planning unit as possible. I went out and recruited somebody that had more degrees than anybody else I could find, and that was Perry Green. So Perry is a CPA, he is a CFA, he's got other degrees that you can see in his bio. And so Perry, do me a favor and please respond to the question of tax rates are going to go through the roof. What are we going to do about it?
David, thanks a lot. Let's see, let me share with everybody real quickly. So as David said, tax rates historically, when you get in wartime, have gone up pretty dramatically and they fall afterwards. So over time, though, those rates do tend to come back in line. So what we are expecting to see over the next few years is, here we go. Thank you. They basically swing like a pendulum. So we get to November of 2017 and saw tax rates come down in general. We saw deductions go up. And so we get to a more taxpayer favorable environment at that point. From the looks of things, where we're headed today in 2021, looks like we're going towards higher tax rates on top incomes, plus reducing the availability of some deductions as well. So we want to kind of take a look at things and see where we are. First of all, are there any tax benefits that are out there? Like David said, the American Rescue Plan Act was passed a couple of weeks ago. So March 11th, we came out with 2 new tax benefits. The first one is an additional $1,400 stimulus check for every taxpayer and their dependents. For single filers, that phases out between $75,000 and $80,000 a year in income. For married filing joint, that phases out between $150,000 and $160,000 worth of income. So we've got that. And then in addition to it, we've also got an expanded child tax credit, which is a credit for children under 6 up to $3,600. And those 6 and up, it's $3,000 per child, and that phases out over time. So those are the new benefits, but let's talk about what we see coming forward. So we're going to look at Biden's proposal and take a look at what was proposed and who's affected. So basically there are 4 groups out there as I see it. There's the group that's making under $400,000 a year, the group that's making between $400,000 and $1 million, those that make over $1 million, and then those that have a net worth of over $50 million. This is additional proposal as well. So let's take a look at what those proposals are and see who they affect. First of all, the expanded deductibility of state and local income taxes. So that is available for everybody and will be a tax benefit across the board as long as you're itemizing. The second is increasing the top tax bracket back to 39.6%. According to the campaign and all the literature we've seen, that's only going to affect those with incomes above $400,000 a year. Elimination of the ability to do a like-kind exchange in real estate. We'll get in a little bit more detail on this, but if this is done, it affects real estate investors across the board. Return of the piece limitation. This is a limit on the amount of your itemized deductions you're allowed. We'll get into this also. And then another interesting one is the limiting the tax benefit of your itemized deductions to 28%. Also looking at starting to subject earned income over $400,000 to Social Security. Tax and capital gains at 39.6%. That only comes in play if your income is over $1 million a year. Lowering the estate tax exemption. It doesn't matter what your income is. It matters what your net worth is, or if you're expecting to inherit something, whoever you'd be inheriting from. So they've looked at reducing that to $3.5 million and raising the tax rate from 40 to 45%. Also on the estate tax side is eliminating the basis step up of inherited property. So we've got an example about this also. And then Bernie Sanders, this is kind of an esoteric one, but there's a strategy called a GRAT. It's a great way of shifting income. This is the one piece that would become effective once the law is signed. Everything else, it looks like would be a January 1 impact, but this change would basically eliminate the viability of this strategy. And so, we'll talk about that a little bit as well. And then also Elizabeth Warren has the ultra millionaires a tax, which is a 2% tax on net worth between 50 million and $1 billion, and a 3% tax on net worth over $1 billion. Think of this as basically property taxes. So this will be a tax every year. So let's kind of get into the meat of it. First of all, for those taxpayers that make under $400,000 a year, what's the situation look like there? Well, Biden's proposal states that there won't be any changes for those making less than $400,000 a year. So the strategies that we've been employing for the last several years, those continue. Let's take a look at what we're trying to do with clients. So the first thing we want to do is, generally speaking, defer recognizing income as long as possible. So let's pay the tax as far in the future as we can. The second is we want to coordinate the timing of your itemized deductions and your standard deductions. And this really matters after the standard deduction limits got raised a few years ago. We'll look at this in a second. And then finally, we're looking at charitable contributions, trying to fund those as tax efficiently as possible. So instead of writing checks to charity, what we're working with clients to do is to use either appreciated stock that they've held for over a year. You get the same tax deduction, plus you avoid the capital gains tax. Or for clients that are over 70 and a half, if you fall in that group, then look at doing qualified charitable distribution. So it's basically a tax-free distribution out of your IRA direct to the charity. So let's kind of take a look at some examples here. So what we're going to look at is bunching charitable gifts versus spreading them. So we've got a few assumptions. First of all, it's a married couple filing joint. The mortgage has been paid off. Property taxes are $10,000 a year. They make $15,000 a year in charitable contributions. And then going forward, right now, the standard deduction is $25,100 a year. We're going to assume that it stays the same over the next 4 years. So what are the options for this couple? Well, the first is they can continue to contribute $15,000 to charity every year. If they do that, what you'll see is the charitable deduction is $15,000. The property tax deduction is $10,000. So that's $25,000 worth of itemized deductions, which is less than the standard deduction. So you get no tax benefit over that 4-year period. You've given $60,000 to charity, you paid $40,000 worth of property tax, but you take $100,400 deduction, which is the standard deduction over that time. So let's see if there's a way that we can improve the outcome. So instead of giving $15,000 every year, we can group the deductions and the charitable contributions. We can use something called a donor advised fund that lets me give away the money today, take the charitable deduction today, and then spread it out, meter it out to the charity over time. But we'll get into more detail on that. But basically, this is the way that you do it. Year one, you'd make $30,000 worth of contributions, pay $10,000 worth of property taxes. So I've got $40,000 worth of itemized deductions. I'd take that this year. Next year, I don't have any charitable contributions, even though I'm metering the money out to the charity. I took the tax deduction in 2021. So I only have $10,000 worth of itemized deductions. I take the $25,100 standard deduction that year. And we alternate every year. So over this 4-year period, I've still given away the same $60,000. I've still paid the same $40,000 worth of property taxes, but the amount that I'm able to deduct from my income is $130,000 instead. So that's if we do it every other year. Let's assume that we come in and we've got some appreciated stock and we want to take the big deduction this year, because not only do we want to group it, but we also want to make sure that we get the benefit at the highest marginal rate that we're paying right now. So what happens is I come in year one, I make a $60,000 donation to that donor advised fund, pay $10,000 worth of property taxes. So my itemized deductions this year are $70,000. That's greater than the standard. The next 3 years, I only have $10,000 worth of deductible items. So I take the standard deduction. Sounds bad because I don't get to itemize, but if you take a look over that 4-year period, once again, I still gave away the same $60,000. I still paid the same $40,000 in property taxes, but the amount of the deductions that I've been able to take is $145,000. So looking through, that's basically $45,000 of income that I'm not paying taxes on over that time period with just this one strategy. So what you've got to do is you've got to be diligent as you're looking through. So if you're under $400,000 of income, it still can affect you. And there's several ways that this comes into play, even though, the proposals say it don't. The first is, let's assume that your income hovers around $400,000 a year. It's $370,000, $380,000 a year. Well, if you have large capital gains in a year, that can kick you up over that $400,000, which causes you to have slightly higher income tax rates and also limits some of your deductions that we'll talk about in a minute. So we've got that. What do we do to mitigate it? Well, we'd look at not only harvesting capital losses, which is something we've done over the last several years, but one thing that we'll look at going forward is trying to harvest some capital gains early so that we can mitigate those big jumps in income. Another thing is, let's assume you're selling a business. If you normally make $200,000 out of a business a year, but you're going to sell it, let's assume you sell it January 1. The only income you have that year is $2 million worth of capital gains from selling the business. Well, $1 million of that's going to be taxed at 39.6% instead of 20. So that's an extra $196,000 worth of taxes that you owe, which is essentially 1 year's worth of earnings. So we've got to be careful there. And then also the other thing, because they've talked about eliminating the basis step up on inherited property, if you're going to inherit a home from your parents, that's all they have. It's a house they paid $250,000, that's worth $250,000 at their death, but they paid $100,000 for it. Today, if you inherit that house and you sell it, you don't pay any tax. You've got $250,000 to put in the bank. But if they eliminate the basis step up, there's $150,000 worth of capital gains that you'd have to pay taxes on. So maybe it's at the lower rates, maybe it's the higher rates, but it's still a tax that you'd incur next year that you wouldn't incur this year. So that's up to $400,000. Now let's take a look at those people that are making between $400,000 and $1 million. So the first question that we've gotten a lot of, and I've wondered about myself, is what if I'm single? Is $400,000 for a married couple? Does that mean single filers only start hitting the higher brackets at $200,000? Well, we had a press conference last week, and one of the reporters, I kind of pushed on that. And initially the press secretary tried to hedge, and it was a campaign promise. We'll check, we'll see. And then the reporter pushed a little bit harder and said, look, I just want to be clear. If I'm single and I make $400,000 a year, my tax bill will not go up. Is that correct? And at that point, the press secretary comes in and says, yes, that is the case. So what we're expecting to see out of the tax bill, and this is very good news for single taxpayers, is those higher rates don't come in until you hit $400,000 as well. So let's take a look at the tax brackets. We've got single taxpayers, we've got married taxpayers. And what we have here is the 2017 brackets. Those were the brackets before the last tax law change. So that's what was in effect during the Obama presidency. We've got 2021, that's what we have now with Trump's changes that he made. And then 2022 is what Biden has discussed implementing for next year. So what you'll see is, basically, if you're a single taxpayer, then that 35% bracket, you still get the benefit of that. What happened when Trump came in is we lowered brackets and we lowered rates on a lot of things. And for those taxpayers below $400,000, what Biden's proposed doing is keeping all of those in place. So basically, before the last tax act, if you were single, you had a little bit of taxable income at 35%. Everything over that was at 39.6%. So you're going back on the higher income to essentially the same structure, but you get to keep the benefit of some of the lower rates. If you're married, filing joint, then what happens is, right now you've got a fairly large 35% tax bracket and your top income tax at 37%. If we start taxing everything at 400 and up at 39.6%, you lose the benefit of both the 35% and the 37% brackets. So let's kind of take a look at what this means. You know, on the face of it, it's not that bad. I'm well over $400,000 a year in income. I'm already paying 37%. You know, my rate goes up by about 3%. It's not so bad. But let's see how everything comes in and works together. So first is if we bring back the piece limitation. This is a limitation on the amount of your itemized deductions that you can actually take. So if your income's over $400,000, 3% of that excess is what your itemized deductions are reduced by. The next is the tax benefit of your itemized deductions is limited to 28%. So, and then finally, Social Security, payroll taxes come back for income over $400,000. So I've got an example that kind of tries to marry all of these up, and let's see how the math works out. So basically I've got a married couple that's making $600,000 worth of earned income. So it's all ordinary income. They've got itemized deductions of $125,000 a year, and they are married filing joint. So under the current law, what happens? Well, you've got $600,000 worth of income, $125,000 worth of itemized deductions. Taxable income is $475,000. You take that number, you run it through the tax brackets, and you come back with a tax due of $119,000. So how does that change potentially under Biden's proposal? Well, the first thing that happens is you've still got the same earned income of $600,000, but instead of looking at your itemized deductions first, we figure out the tax on that $600,000. The tax on that is $168,800, so basically $169,000 worth of tax on the $600,000. Next thing we do is we look at your itemized deductions for $125,000, but because you've got an extra $200,000 worth of income, those deductions get reduced by 3%. So instead of getting to take $125,000 worth of deductions, you get to take 119. And instead of the tax benefit being 39.6%, which is the same rate that you're paying taxes on, that benefit is actually 28%. So it's actually $33,000. So the tax bill at that point turns into $135,000 just on the income tax side. So this assumes nothing on the additional payroll tax. So that's a $16,000 tax increase, which is 13.5% essentially increasing what your tax bill is. So let's assume now, let's take a look at the earned income limits. So Social Security, right now, you pay tax from $0 to $142,800 a year. And this number, that $142,000 limit increases each year for inflation. If you're self-employed, you pay both sides of it. It's 12.4%. If you're an employee, your employer pays half and you pay the other 6.2%. Today, everything you make over that, you don't pay Social Security tax on. What Biden has proposed is coming in and saying, all right, any earned income that you have over $400,000, we're going to restart the Social Security clock. And what you would think, or you'd like to see, is that maybe this band shifts over time. But what's going to happen is the way the system's set up is this $142,000 number increases and the $400,000 number just stays put, so that over time, what you end up having is Social Security similar to Medicare, where you pay the tax on all earned income. So let's take a look. Let's go back to our early example, and let's just assume that you've got a sole breadwinner in the house. You've got one person that's making $600,000. They're still doing the $125,000 worth of itemized deductions. Well, if that person's self-employed, they're paying an extra $24,800, so almost $25,000 a year in additional Social Security tax. If they're an employee, it's an extra $12,400, and their employer's paying the other half. So let's kind of try and pull all this together and see what kind of the worst case scenario is. So if you are under the current tax bill, you've got the income we've looked at, then whether you're self-employed or you're an employee, you owe $119,000 worth of taxes. Looking at the income tax changes, that jumps the tax bill to at least $135,000. So the next thing that we have is the potential Social Security tax increases. If you're self-employed, then that tax bill goes up to $160,000. If you're an employee, that total increase in total tax is $148,000. So we're talking about a tax increase of anywhere from $29,000 to $41,000 a year. Helping put that in perspective. Tuition, room and board for an in-state school on average is about $23,000 to $24,000 a year. Out-of-state public school tuition, room and board average is about $35,000 to $36,000 a year. So you're really looking at 1 year's worth of college tuition and additional taxes here. So that's that level. Let's look at people that are making over $1 million a year. Now there are going to be those that are making $1 million year in, year out. And then there's also kind of the accidental millionaire. So what could cause this to happen? Well, let's assume that you've got a building that you've owned for 10 years. It's worth $9.5 million. So you want to sell it. And your original cost was $4.2 million. So it's real estate. You've depreciated over time. Your basis is $1.7 million. It's also real estate. So the bank's still involved. You still owe $2 million on the mortgage, and outside of the sale of this building, you've got $300,000 worth of other income. So let's kind of see how all these things come together to affect things. First of all, regardless of what you're looking at, current law, future law, the sales price is $9.5 million. Your basis is $1.7 million. So in both cases, you've got a gain of $7.8 million. So far, so good. Real estate today, though, has kind of three tranches in how you tax it. So the biggest piece in this example is taxed at capital gains rates plus the net investment income tax gets you to 23.8%. So that's $5.3 million is taxed that way. You got $750,000 that's at 25% rate, and you've got $1.75 million that's taxed as ordinary income, and that's 37% rate today. Well, if we flip over and look at Biden's proposal, remember, we've got $300,000 worth of income to begin with. We get another $700,000 worth of income that we still pay the lower tax brackets on. And then over that, we've got income over $1 million. So that gain's taxed at 39.6%. So just kind of putting in perspective, what's that do for the tax bill? In today's regime, you end up paying $2.1 million essentially in income taxes on the sale. Under the Biden proposal, it would be basically $3 million. So we're looking at about a $900,000 shift in the tax bill. And this assumes that you've been in the real estate business and you want to get out, you want to be done. What happens if, and so the effective tax rate is today almost 27% versus a little bit over 38%. So let's see what happens if we want to take that, and instead of getting out of the real estate business, I just don't like this particular building, I want a different one that I want to get into. So either way, I've got a $9.5 million sales price. Either way, I still owe the bank $2 million when I'm getting out. And then if you think about what happens today, if I'm in real estate, I can roll that gain over into my next building. So today, my tax bill is zero because I've pushed that tax out to future years. Under the Biden proposal, if you do away with the ability to do these like-kind exchanges, you got to come up with essentially $3 million worth of tax at closing. So the amount that I've got that's available to reinvest in my next building today under the current tax law, I've got $7.5 million to go into the next building. Under this proposal, it's $4.5 million to go into the next building. So kind of putting this in perspective, it's a lot like the 1986 Tax Act. So what happened then was real estate was an investment, but it was also a tax shelter. So you got the benefit of depreciation, interest expense, and a lot of other things. That got pretty much shut down if you weren't actively involved in running the real estate. And so caused significant problems. So there was a study that I found that looked at the amount of multifamily housing, new starts of multifamily housing from 1986 through 1990 dropped by 71%. So, this inability to roll over gains could be a game changer for real estate. So let's move on from there and look at those of you that have a net worth over $50 million and what's kind of on store there. Elizabeth Warren has come out and said what she wants to have is basically an additional tax on the top 0.5%. What it would be is a 2% annual tax on net worth between 50 million and $1 billion. Over $1 billion, it's 3%. What comes out of that? So you're going to have to ramp up the IRS because they're really not structured for this. One of the things that I copied this from our website and went back and double checked. Talking about $100 billion investment to rebuild and strengthen the IRS. Now it needs a revamp, but $100 billion is a little strong. The next thing that they've looked at doing is a 30% minimum audit rate for taxpayers that would be subject to this tax. So think about it. What happens is you got to fill out your tax return just like you do every other year. And then I assume you'd have an attestation that says I'm worth less than this, or if you're in that range, you've got to basically fill out a balance sheet. And essentially every third year, the IRS is going to be coming around to do not only an income tax audit, but also a net worth audit. And for those of you that decide I'm not going to be subject to this, I want to get out of the US, well, there's a 40% tax to exit. So if you want to avoid it, you're going to basically cut your net worth in half to do it. So that's what the $50 million tax looks like. Now, has this ever happened before? There are countries in Europe that, yes, do tax net worth. The US really hasn't had this in the past, but we have had something similar. If you go back to the late 60s, there was an article that came out that said there were 155 taxpayers that had over $1 million worth of income that paid zero tax. Now, part of that was they invested in municipal bonds, they did a lot of charitable gifting, but basically they structured their tax return so that they didn't owe any income tax. And that's when Congress came up with the alternative minimum tax. Remember, that was originally set up to focus on 155 taxpayers. If you go back and look at what that's grown to in 2018, there were about 5 million taxpayers that had to pay that tax. And not only those that had to pay it, but countless others that still had to go through the mental gymnastics to figure out whether or not that tax applied to them. Based on the projections for the next few years, it looks like higher standard deductions, lower state income tax deductions, and a few other things, the AMT kind of goes away for several years, but it should be coming back with a vengeance in 2026. So let's think about this. The thing to keep in mind, I've talked about this with a lot of attorneys, a lot of CPAs, and the first thing we all come to is, Congress is rich. They're not going to go against their own self-interest. So, I wanted to test that just to say, well, Roll Call has got a list that they put out occasionally, and this is from a couple years back, that lists the net worth of all of the members of the House and Senate. It's pretty amazing. So what we found out, this is what I'm going to show you, is the people that are going to be voting on these income tax changes, estate tax changes, and the like. Basically, 23% of the people in the House and Senate are insolvent. According to this Roll Call publication, they had less than 23% had a negative net worth. And then you're looking at the group that's 5 million and up, you're basically talking about less than 13%. You're talking about less than 20% of the Congress has got an estate that would be subject to estate tax, even if it's $3.5 million limit. So this is the group of people that's voting on it. The next thing is kind of what's my predictions for what's going to come out of this. So first thing is the expanded deductibility of state and local income taxes. There's almost no way in the world this doesn't pass. And so this is a benefit to anybody. This doesn't hurt anybody, and it's something that's been a campaign promise for a long time. I expect to see that come back. Next is increasing the top marginal bracket back to 39.6%. If you think about it, that was the law a couple of years ago, and the optics are it's less than a 3% increase. So that probably comes through. The elimination of the 1031 exchange. So that's the ability to take your real estate gains and defer the tax off until you finally decide to get out of the real estate business. I give that kind of a 40% chance of passing. It would raise some revenue, that's true, but the impact that you could have on the real estate market is far outweighs the budgetary impact that you'd have. So maybe it passes, but hopefully not. The return of the piece limitation, remember, that squeezes the amount of your itemized deductions that you get to take. That's pretty much a given. I give that a 95% chance. Limiting the tax benefit of itemized deductions to 28%. This is probably kind of 60-ish%. More likely than not, hopefully it doesn't pass, because it makes sense in my head that number would, that the benefit would equal whatever your current rate is. Taxing or subjecting earned income over $400,000 to Social Security. That's kind of a 75% rate. There's some question as to whether or not that can go through a budget reconciliation, or you'd have to have a separate bill. But Congress is looking for a way to shore up the Social Security numbers as well as they can. And so, the goal is to tax as much as possible. This just lets them get to 100% sooner. Increasing the capital gains rate to 39.6%. I say it's probably a 65% chance, but maybe we get lucky. Maybe instead of taking it from 20% to basically 40%, they take it from 20 to 28%. That's still a large increase. It's an 8% increase, but from the optics, Biden can look at Republicans and say, what are you complaining about? That's essentially the same, that's the same rate that Reagan set it at. So probably we come back to that cap at 28%. Lowering the estate tax exemption to $3.5 million. The estate tax exemption is going to go down. Even under the current law, it's scheduled to fall back to a $5 million index amount in a few years. Hopefully, Biden takes the position that Obama's the one that signed the $5 million exemption into law, and so we go back to that level. The elimination of the basis step up for inherited property, I give that kind of a 10% chance. It sounds good, but if you think about it, first of all, it would apply to everybody across the board. Second, it's a nightmare to keep up with. I was talking to somebody the other day that's trying to figure out what the value of a farm is they inherited from dad 25 years ago. Well, think if they had to go back and figure out not what it was worth 25 years ago, but what if they had to figure out what it was worth 50 years ago when dad originally bought it? So the administrative nightmare on the basis calculations is probably what saves us here. The Bernie Sanders for the 99.5% Act, this is the GRAT piece that I was talking about. That probably happens. And so that's been talked about for several years, and it's finally come out as a proposal. I expect that hits. And then Elizabeth Warren's tax act, or excuse me, millionaire tax, that probably doesn't go into effect just because of the administrative burden and nightmare that would be to try and enforce. So that's kind of our predictions on what comes up. One quote that came up, I remember this from one of my first days in tax research class, was an appellate court judge, Judge Learned Hand, and basically came out with a tax case back in the 30s or 40s that said, you've got the right to organize your financial life any way that you want to. You've got to follow what the tax rules are, but you're not required to set up your life so that you pay the most to the U.S. Treasury. So our goal is to help you work to figure out how to mitigate that tax bite as much as possible. So let's kind of take a look at some of the to-do list and things that we're recommending that people do over the next couple of years. First is, let's just assume you're charitably inclined, regardless of what your income is. Use appreciated stock, or if you're over 70 and a half, use the qualified distributions from your IRA instead of cash for contributions. And second, if your adjusted gross income's over $400,000, you might look at going on and pulling those deductions into 2021. That way you don't have to worry about whether or not the piece limitation passes, and you don't have to worry about that 28% limit on the gains. You get the full if I give away $100,000 to charity and I'm in a 37% tax bracket today, my tax bill goes down by $37,000. Wait till next year, give away that same $100,000, assume it's all deductible, but they cap the amount of deduction I can take, then it's a $28,000 reduction to my tax bill. So go on and accelerate charitable contributions today. If you're planning on selling a business in the next year or so, I'd try and close by year end. If you're not going to be able to sell by year end, then maybe you look at doing an installment sale, and that will let you recognize the gain over a multiple year period. So that keeps from pushing so much of it into that $1 million plus range. If you're looking at selling a piece of commercial real estate, if you can get it done by the end of 2021, probably a good thing. Otherwise, if all of these things come to pass, then you may be looking at needing to be prepared to hold on to that till that tax pendulum swings back. If you've got earned income over $400,000, and then going forward, what you want to look at is possibly a non-qualified deferred compensation plan. It's like an extra 401k contribution for highly compensated people. And then also you'd look at trying to harvest capital gains. If you've got an asset that you've been looking at diversifying, whether it's you bought Tesla stock 5 years ago or whatever it is, and you want to take some gains, this is probably the year to do it. If your net worth is between $3.5 and $5 million, you need to update your estate plan between now and year end. And then, assuming that you can afford to do so, you need to make look at making significant transfers to the next generation, or also setting up some other trusts that we're looking at for asset protection for you as well. If you're somebody that's been doing these GRAT transfers that we've talked about, this is the one law that would come into effect on passage of the bill. So let's assume that this bill passes and it gets signed July 1st. Then any of these transactions done July 1 or later, your current transactions are basically don't work. So what I'd say for those people is you'd want to get in early over the next 30, 60 days and set up several of these transactions to stagger them out over the next 2 to 10 years instead of trying to continually roll the same amounts. And then the next thing is, if your net worth's over $50 million, look at harvesting capital gains this year, because this is definitely going to apply to you. And then also updating the estate plan. If you haven't done these grants that moves a lot of growth out of the estate, look at doing that or other transfers to help mitigate what the estate tax burden is going to be. And so the big thing to keep in mind is this slide shows the difference between the top marginal tax rate. So if you go back and look at 1979, the top rate was 70%. But if you look at the average income tax rate that people were paying in the top 1%, it's about 20%. 20% is what the average tax is that they paid. And we've seen those marginal rates come down over time, but the average rates stay constant or actually kind of increase. So what's really going to be important for you over the next several years is, as we get into a higher tax type of an environment, looking to help spread this gap as much as possible. So we're trying to work with clients to help have as large a gap as possible between what that stated rate is and the amount that they actually pay. So it's something that's going to definitely require a lot of work and a lot of coordination between your entire team. With that, that's kind of the high points. Any questions?
Yeah, I'll sort of administer over this. Perry, we've had several come in, and thank you for all the effort you put into trying to frame this for us. It does frighten me, and I'm sure it frightens the 100 people or so who are listening to you, but it does comfort me that you're on top of this. And I know people have talked about this, but I hadn't seen a presentation this robust out in the marketplace yet. So we should be on the front of this, and thank you for putting the effort in to get us there. All right. One of the questions I get is how will this impact asset markets? I don't think it really will have much of a depressant impact on the stock market, from the sense that you end up selling a whole bunch of shares to try and lock in a lower capital gains rate today. Then you might end up paying next year because you have to reinvest in something, and stocks are still the most attractive, I think, asset class. As Perry detailed, it could have a significant impact on the real estate market, because if you're unable to roll those gains forward, then it cuts your purchasing power in half across the entire real estate, at least the institutional commercial sectors. That is pretty significant. As Perry said, that might make it difficult to pass once people recognize it. But if the 1986 tax reform was sort of the Republicans' big bang tax reform, then 2022's tax reform could be the Democrats' big bang tax reform as a rebuttal. And who knows how that sorts out. Perry, one of the questions was just one of timing. When do you suspect this could get passed into law? And do you suspect that any of it could be retroactive?
It theoretically could be passed retroactive. Most everything I'm seeing and expecting is the changes don't take effect until next year. I can't imagine doing it if I'm in Congress. I'd rather do it next year. I get the benefit from my base of having raised taxes, but I don't have the detriment of anybody actually having paid the higher taxes. So that's why I expect it's next year.
So you mentioned that the pendulum swings like it did 2017 to 2022. When the pendulum swings this time, of these provisions, what do you expect will get written right back out? Like Trump did the SALT deductions, and now those could get removed. The state and local tax deductions, which you talked about earlier. Are there certain of these provisions that you view have a likelihood of more permanence? And are there others that you view will just be swung back if indeed the Republicans end up retaking Washington?
So I think the things that have the shorter life expectancy are doing away with the basis step up. I think that if that gets enacted, they'll bring it back. I think there's some probability that if the estate tax gets dropped to $3.5 million, I think that probably increases. The top tax rate at 39.6% probably has some staying power. And then the other thing that you mentioned is what happens if you do away with the ability to defer gains on real estate. That could be pretty impactful. I mean, if they can, hopefully, if that does come in, that would be something that gets pulled out, but I'm not sure where that would be. And then the most staying power would be a couple of these things that are targeted strictly at the highest net worth. Those probably have the most staying power.
Perry, I've gotten a couple of questions on the piece limitation coming back. Yep. Can you just take a moment to unpack again what that piece limitation is and who would be affected?
Yeah, so in the past, the limit was low. It came in the past, it was a level below $400,000. But today what they're saying is if your income is over $400,000, let's see if I can get back to it real quick. My income's over $400,000, then what happens is we look at the excess. So in the example, got $600,000 worth of income, 200,000 over. So 3% of that excess is $6,000. So you reduce the amount of my allowable itemized deductions by $6,000. This is something that it's a huge headache from a planning perspective. It can basically knock out your ability to take itemized deductions if your income's high enough. And it was law a few years prior to 2018. Probably comes back.
Real quick, while you're vamping on one more question, can you just put your predictions slide up?
Yeah.
And there will be copies of the slides available if you want them. Just contact us, contact your strategist. And just to confirm, these are Perry's predictions and probabilities. Pull those off of Ernst & Young's website.
And so, and the likelihood that it'll be interesting to see what does actually come out over the course of the year. We probably have a bill later in the year. Like I said, most of it probably takes effect January 1, but trying to figure out what starts out in Congress and what comes out the back end on the president's desk. Sometimes it's not anything different.
One of the things that I'm also seeing in the chat, how do I come up with strategies to reduce my income, right? So if I'm fearful that my household income will bump above that 400 metric, what are the things maybe that I or my spouse can do to try and reduce that earned income?
Well, and so that's strategies that we're working on today. Sometimes it is, if you work for a large employer, they have, like I said, a thing called a non-qualified deferred comp plan. It's like an extra 401k that's available. There's some potential pitfalls that you've got to worry about with it. So you need to take that on a case-by-case basis. There's charitable gifting. A lot of what's going to happen is sitting down, taking a careful inventory of where you are today, what you're doing, and figuring out a 3 to a 5 year strategy for what your income looks like. Maybe I do have to bump up over $400,000 one year, but if I do that once and it keeps me below it for the next 3, then we just got to figure out the timing and what makes the most sense.
Thank you, Perry. I'll close with one final thought, and this is a conversation that we have internally. If you recall from our Outlook 2021 presentation, we did talk a lot about the benefits to all of this wartime spending, a lot of the government fiscal and monetary stimulus, and that would increase GDP at a substantial rate. Well, we're partying right now like it's 1984 because GDP will likely grow this year 6.5%, 7%. We haven't seen growth rates like that since 1984, which for those of you who know me, I frame as the best year ever. So we're going to see all this GDP growth. There's a lot of cash on the sidelines. The stimulus checks hadn't even really hit yet. So we're going to see a lot of spending, and we're going to see a lot of corporate earnings growth over the next 12 months. And so it's going to be a fantastic year. But ultimately, the gains that we receive in the stock market only matter to the extent that they show up on your balance sheet, right? So tax strategy ends up being super important, if not more important than investment strategy, I believe. And it pains me to say that as an investment guy. But I do think Perry and the CPAs that we have within the firm and the advisors that you're working with end up being more important at the margin over the next few years, even than your investment folks, because it's your net after tax rate of return that really matters. And based upon the analysis I've done and that the team's done, we are set up for substantial tax increases. And as Perry said, within the confines of the law, we are still, I think, compelled to do everything we can to keep as much of the money that you've made in your pocket rather than transferring it to the government. So for that, I do have a saying, right? If you can pay somebody to worry for you, do that. We'd be happy to worry for you at Waddell & Associates, and I assure you that we worry a lot about your hard-earned capital. So with that, Perry, I will close by saying thank you so much for all the worrying you're doing on behalf of all the clients. And I will also assert that this will be a series of presentations as we get more information, and we're going to get more information this evening, I believe, as Biden rolls out his infrastructure strategy. So with that, Perry, thank you to all of you all. Thank you for tuning in. We will have this available on our website in a recording. And as I said earlier, if you want the slides, just let us know. So enjoy the rest of your day, and thank you for tuning in.
Thanks.